Well, the burrito chain Chipotle has done it again. This is a stock and a company that seemingly defies all expectations repeatedly, over and over again. It's a bit like Costco. It's a company that seems simple, easy to understand. There's not much to it, but yet the stock price continues to race up as though it's an EV stock or an AI stock. It's compared to Nvidia with its incredible performance. The stock price is outstandingly high, trading above a 54 PE ratio. And recently they just announced a 50-for-1 stock split. Yes, a 50-for-1. And the reaction from the market was to push the stock ever higher, up another 6% today. It's bouncing between $3,000 per share. In fact, it just surpassed $3,000 per share a couple hours ago. This stock is on fire. It is unstoppable. Chipotle is either one of the most overvalued stocks in the market, or it's some type of compounding machine that's just unstoppable, and it will continue to gain market share until eventually everyone's eating Chipotle burritos. In this episode, we'll be going over all of it. This 50-for-1 stock split, what it means for the stock, the type of consequences this has, as well as this stock and the valuation of it. So we have a full episode, a lot to get into. Let's go ahead and get started. Let's first take a look at the actual news release here. They say that shareholders of record as of June 18, 2024 will receive 49 additional shares for each share held. Now, don't get too excited. You're not just going to receive free money. That's not what a stock split is. You're going to receive 49 additional shares for each share you hold, but every share will be worth 1/50th of what they used to be. So you're not getting any additional equity in Chipotle. You gain nothing and you lose nothing. They're just taking one share and chopping it into 50 small pieces. Now, there are some different ways that this actually impacts Chipotle stock. I'll talk about that in a minute, but let's continue on. Chipotle shares are expected to begin trading on a post-split basis at the market open of Wednesday, June 26, 2024. So we still have a couple months until this stock split will take place. Chipotle could go down in price a lot or even go up further. So we don't know the post-split price it will trade at. But based on a $3,000 market price, that means that Chipotle will likely trade around $60 per share. So we're going from roughly $3,000 per share to $60 per share. That is one heck of a stock split. Now, they say that this is the first stock split in the company's 30-year history. And I'll add that this is one of, if not the biggest stock split in the stock market's history. In fact, I tried to search for a bigger stock split than a 50-for-1. I can't find any. The closest I found was Google's. This is a 20-for-1 stock split. But Chipotle's being 50-for-1 is massive. I've just seen nothing like it in history. So it draws a lot of attention seeing this big of a stock split. They say to commemorate this special event in recognition of the company's strong performance, Chipotle announced a special one-time equity grant for all restaurant general managers as well as crew members for more than 20 years. So if you're a crew member and you've been there for 20 years, which seems like a really long time, so probably not too many people, but if you happen to be there for 20 years, then you're getting an equity grant, or more likely if you're a general manager. Lots of general managers at Chipotle, they want to hang on to these employees, so they're incentivizing them through equity grants here. So that's the news release from the company. Now, there's a couple ways that this impacts the actual stock. Even though on a technical level, you're not gaining any equity in the company, this does have a bit of an impact on the fundamentals of the stock. One of them is liquidity. When a stock price goes up to $2,000 per share, $2,500 per share, $3,000 per share, it's becoming less and less liquid. You have an illiquid asset. It's moving into the category where to buy one single share, it's like making a down payment on a car or even an apartment. It's buying something major to buy one share. $3,000 is just a lot of money. To buy a single share of a company, that is a lot of money. And when investors are considering what companies to buy, they're looking at the list here. They're looking at companies like Apple, and Apple's price is $176. That you can afford. You can buy Microsoft. Even $400 is affordable for most people. You have companies like Google, $148. Again, not too bad. And then you have Chipotle at $3,000 per share, which frankly is just too expensive for the majority of people. So this boxes out the majority of investors from entering into a position. And I think that's a very negative thing for the company, the liquidity, the investor base of it. And I've noticed this on my YouTube as well. Chipotle is an excellent company that's easy to understand. It has a great track record and a very bright future. But despite that, it does not have a big following online. There's not many retail investors buying this stock. And I think the very high share price has something to do with that. The majority of investors do not have an extra $3,000 lying around to buy a single share of a company. So splitting it into chunks of $50 or $60 a share opens up the addressable market of investors. It adds liquidity to the stock. And I think that you're going to see more people buying into Chipotle after this stock split. Now, another thing it does, breaking it from $3,000 to only $60 per share, is makes it more eligible for different ETFs. Many of them have restrictions on the share price that they can have in a company, like the Dow Jones, for example. We saw that Amazon did its stock split and then it was introduced into the Dow Jones. And I could see Chipotle potentially being in that position again. This company's only going to grow. It's only going to grow its free cash flow. It's an incredibly strong company, but the $3,000 share price keeps it out of the Dow. The added liquidity also makes it more likely that people can run covered call strategies on the stock and generate income from Chipotle. Before the stock split, you'd have to own roughly $300,000 of the stock. Now, post-split, you'd have to own roughly $6,000. So this makes it more liquid for everyone all around, increasing the total addressable market of potential investors for Chipotle. So I think added liquidity is an advantage and a good thing for Chipotle stock or any stock. Taking away that advantage and making it illiquid is not a good thing. Now, that's not the reason that I invest in this stock. I invest in compounding machines, companies that I think have incredibly strong market position. They have pricing power. They have great brand value. They're companies that are very, very difficult to compete with. And they're companies that grow free cash flow per share on average above 15% per year. And they can do so for a very long period of time. I invest in companies that have incredibly strong balance sheets, that are resilient, reliable, that they don't have any chance of going bust during a recession. And Chipotle is one of these companies. When I look at Chipotle in my portfolio, I have a $36,000 position. That's roughly 12 shares. So 12 shares of the company, $36,000 with $12,000 in gains. This has been a huge market-beating position for my portfolio. I introduced this position in 2023. So it's up 53% in less than a single year. The reason that I first purchased Chipotle was outlined in this slide. I believe the company has secular trends of market share gain in QSR. QSR is quick service restaurant. Things like McDonald's, Wendy's, all those different type of restaurants. Chipotle has secular trends and it's gaining market share. People want to eat something that's a little bit healthier than French fries and fried chicken. And although there's a million places that offer French fries and fried chicken that are very popular, there's not as many that offer at scale really good burritos made from fresh ingredients. Having actual guacamole, rice, beans, salsa, and grilled chicken produced fresh every single day across thousands and thousands of different restaurants, all working in cohesion with an app and digital properties, that's very difficult to replicate. People try to talk down Chipotle and they say it's just a burrito chain. And who would buy a burrito chain? The truth is it's not just a burrito chain. It has digital properties. It has incredible processes to keep the company functioning at the scale that they're at. And these processes, these type of digital properties are very difficult to replicate. That's why you don't see many companies at this scale offering fresh food. It is very difficult to replicate, and I think that's part of their moat. Another thing that I highlight in terms of secular trends is there's more and more families where they're dual family income, where both adults in the household are working, which leaves you less time to cook and higher household incomes. People are having fewer children. The cost effectiveness of cooking at home is raised when you have more children to feed. So if you have 5 or 6 kids, it's way more cost effective to cook at home. But if you only have 1 or 2, it's a little bit less cost effective. So with dual family income and fewer children, more people are choosing to eat at places like Chipotle. Now, there's always been a strong preference for convenience above all else. And that's proven by the fact that people still use Uber Eats and DoorDash, even though it is incredibly expensive. They prioritize convenience above cost. And that's why you see such strong pricing power with Chipotle. They have consistent new openings with Chipotlanes. They're opening up hundreds of new locations every single quarter. Mexican food is simple and loved in every part of the world, and it's healthier, clean ingredient food. Now, clean ingredient can mean a lot of different things, but in this case, they're basically using very simple ingredients. The entire restaurant has 53 ingredients. So it's not a lot of processed food and the type of stuff you're seeing at McDonald's or Wendy's. And then finally, they believe their total addressable market is roughly 7,000 restaurants, where they're just past 2,600 right now. So I invested in Chipotle based on this investment thesis and when the stock was going through a sell-off. It went down to $1,900 per share, and that is my average on this company. I bought in $20,000 at $1,900 per share, and it's rose up now to roughly $3,000 per share. So where does that leave us now? The valuation of Chipotle. When I look at the stock right now, it has a 52 forward PE ratio, which raises a lot of eyebrows. But when we look at the free cash flow yield, it doesn't look quite as bad. It's 1.5%, which is still very expensive. So at first glance, I realize that this company looks wildly overvalued, but I want to put these numbers in context. If we look at the fundamentals of Chipotle, the first thing that I'll point out is it's simply growing really fast. We look at the growth over the past decade. It's gone from, in 2017, $4.4 billion in revenue to 9.87, over doubled since 2017. And keep in mind that this is not through acquisitions or bloat or acquiring companies by issuing debt and shares. They're not doing any of that. This is all organic. 100% organic revenue growth. They're growing by growing their digital sales, opening new locations, opening more Chipotlanes, and raising prices. All of those lead to a very strong organic growth profile where it's growing roughly 15% revenue per year. And again, this is very attractive revenue growth. Now, we look at the profitability of the company, and I measure this through free cash flow. Free cash flow is the amount of money, the amount of cash left over after paying for all of the operating expenses of the company, so employees and different operational costs, as well as your cost of goods, so producing the burritos and selling them, and even after paying for CapEx. So you subtract out the CapEx as well. This is what is left over to the shareholder. When we look at Chipotle's free cash flow growth, you can see the incredible progress they've made. Again, in 2017, it was $250 million. So it's still profitable on a free cash flow basis. But last year, 2023, it was $1.22 billion. And the year before that, in 2022, it was only $844 million. Now, Chipotle is also doing share buybacks. So they're purchasing up stock, making the free cash flow per share grow even faster. Year over year, last year, the stock grew free cash flow per share at 47%. That is a substantial jump up. So even though the share price is going up, it's gone up 60, 70%, the stock is growing its intrinsic value by 47%. So it does have incredible growth in intrinsic value year over year. And my expectation is this is going to continue. I believe it will grow its free cash flow per share well above 20% year over year. Now, outside of the free cash flow per share, we also look at the simple, predictable metrics of Chipotle. The company doesn't take on a lot of risk. They have no long-term debt. This is the really bad debt. Zero. They've never had any in their entire history. They have a lot of cash on hand. It goes up over time. So they have $1.3 billion in cash. Now, they do have capital leases. This is a form of obligation, so it's on the balance sheet. But this isn't like long-term debt. This is more of an operational expense of running the restaurant. This is the leases to lease out their property. So when they close down a restaurant, this debt goes away. They can sell the lease. So the company's in an incredibly strong capital position right now, which leads to downside protection. In the case of a recession, they'd be very well positioned to weather through. It also makes it so that they don't have any unexpected bills, and they're less sensitive to interest rates. So there's a lot of strength coming from their capital position with their cash and debt. We also look at the very predictable share buybacks. They continue to do these year over year. We can actually see that they're accelerating the pace of their share buybacks. In the past 5 years, it was only 0.23% reduction, which is not really meaningful. But in the past 2 years, that increased to 1.5%. So as they're gaining cash flow, they're buying back more shares more aggressively. And I love companies that do share buybacks. When I look at Chipotle's return on capital employed, this is the metric that Terry Smith uses as the key indicator of a quality company. You can see this going up over time. In 2020, it was 5.6%. 2021, 13.9, 19.3, and then 2023 it was 22%. This is getting in the range of Costco-like return on capital employed. This is a measurement of how much money they're making the shareholder for how much money they require, meaning that this company's producing a lot of returns without a lot of money. As they become more profitable, as they grow margins over time, and they get to better scalability, this will only go higher. And again, this is already very strong for a restaurant company. The consistency is another thing that I notice. It's very consistent over the past 4 years. Their gross margins are going up over time. Their operating margins are going up over time. Their profit margins are going up over time. So you have a company that's not only growing revenue 15% per year, but every single margin is going up with the company. The returns on capital employed is going up with the company. Revenue growth and margin expansion almost always lead to a stock price going higher. I rarely see companies that have strong revenue growth and margins expanding that have the stock price go down. It can happen, but it's just typically not the case. So in terms of fundamentals, I believe that Chipotle is a true compounding machine. It has a long, continuous runway of growth. It has an incredibly strong balance sheet. It has a good organic growth profile with both its revenue, free cash flow, and margins expanding. Overall, I see this as a story stock that still has an incredibly good story, and I believe they'll be successful internationally. So in terms of my position in the company, I just don't see any reason to sell out of it right now. I'm not buying it right now, but I'm also not selling the stock. Right now, for me, it's just a hold. It's a little too pricey to buy. There's other companies in my portfolio that I think are a little bit easier buys. But in terms of the fundamentals of the company, it's very difficult for me to sell a company that has this strong of fundamentals. So for me, I'm not currently buying Chipotle here, but I am very happy with my position and I'll continue to hold. That's all for now. Hope you enjoyed. See you in the next one.